Hi everyone and welcome to today's HUBsights webinar. I'm Anne McDonald, the Head of Marketing here at Hub24, so thank you very much for joining us. Today we actually have a first in that it's our first international webinar, and we have Jordan Sheiner, Donald Gimbel and Matthew Sherer from Geneva Advisors joining us from Chicago. We're fortunate to also have here in the room with us in Sydney, Richard Murphy and Simon Reardon from XTB. Before we kick off, just a few housekeeping items. We'll open up to questions at the very end of the webinar, but please feel free to send your questions through during the presentation via the webinar functionality. The lines will remain muted during the presentation to prevent any background noise, so if you have any questions, just submit them during them and we'll get the presenters to address them at the end in a combined Q&A. So thank you Richard Murphy and Simon Reardon for joining us today, and you're going to be discussing corporate bond access on the ASX.
Indeed, and thanks very much, everybody. This is a very different type of presentation. It's obviously about fixed income, and we are not a fund manager, so it's not about us per se. It's all about access to individual corporate bonds on the ASX. So what I'm going to talk about today is, do I just do this down here? Yep. Okay. The agenda today is why hold bonds in the first place? What's the rationale? How do clients currently access bonds? What's the difference between holding bonds directly and holding them in a fund? That's actually quite fundamental. How do you get access to corporate bonds on the ASX? How do you get access to SMAs, etc., and models? Investing in bonds in a rising rate environment. As we all know, fixed rate bonds go down in price when rates go up. So what do you do when there are rate rises on the horizon? Then we'll look at a couple of example portfolios, then look at the actual performance of bonds. So why corporate bonds? Why are you interested in fixed income in the first place? Well, obviously it's the defensive fixed income asset allocation in your portfolio. Bonds are, generally speaking, negatively correlated to equity. So talking here about senior corporate bonds, government bonds are generally negatively correlated to equities. To be clear, we're not talking about hybrids here at all, different beast altogether. This is about senior bonds, which are pure debt. Senior bonds have got very low capital volatility when it comes to trading. If you looked at equities from the year 2000, about 15% volatility. Hybrids are about 7% volatility, and senior fixed rate bonds are about 2 to 3% volatility, and the floating rate bonds are ultra low, 0.3% volatility. So that's one of the core reasons you look at bonds. They have super low volatility when it comes to trading. As a result of their seniority in the capital stack, and as a result of the fact they mature, you have utter predictability of income and capital. And what I mean by that is, on the day you invest, you know you're going to get $100 back from a bond, and you know exactly what the coupons are going to be, and you know all of those dates. So that means you know precisely what your return is going to be before you invest, subject only to the corporate meeting its obligations and not defaulting. So this allows for outcome-based investing, what the institutions would call liability-defined investing, meaning that a client who knows that they need $20,000 or $40,000 or $60,000 income for whatever outgoings they have, you can actually plan that against very known, highly known income coming from bonds. So outcome-based investing is very much facilitated by fixed income and bonds in particular. In terms of risk return, they sit next to TDs on a risk return profile. So if you're looking at a total risk return profile of government bonds, TDs, senior corporate bonds come next, and then old style subordinated bonds would come next, and then new style tier 2 hybrids, tier 1 hybrids, and then equities. So they're down at the low risk end of the risk return spectrum. They're also similar to TDs in terms of payment structure. They both have money in, money out, and income along the way. So a lot of people who buy XTBs and corporate bonds are doing so because there's a little more return for a little more risk, but very similar in risk and similar in that sort of payment structure to term deposits. So if you think about that, government bonds and senior bonds and XTBs and senior bonds, they're the only securities on ASX with 100% predictability of what you're going to get before you actually start investing. And that's why a lot of people are moving from TDs into those securities. As I said earlier, only corporate default impacts those returns. So corporate default of an ASX 100 company, there's been 2 of those in the last 30 years, Babcock and Brown and Pasminco. in the early 2000s. So it's a pretty low probability of default. 3-year bonds have got a 0.3% probability historically, as measured by S&P, and most of the XTBs are 3-year bonds. So XTBs, what are they? They are individual bonds, essentially broken down from the $500,000 lots that you trade them in the wholesale market down to $100 securities on the ASX. Bonds were only really available historically to the wholesale market. There's about $100 billion worth of bonds issued by the major corporates of Australia to the major asset managers of Australia, by the major banks of Australia, but individuals, generally speaking, find it very, very difficult to get access, if at all, to corporate bonds. So the concept behind XTBs was take them out of the wholesale market and package them up in individual securities called XTBs that you can access then in $100 lots. Conceptually and even structurally, you could view them as a single bond ETF that is going to mature, because structurally that's exactly what they are. So a Lend-Lease XTB will mature when its underlying Lend-Lease bond matures. It will pay out its coupon. When Lend-Lease pays the coupon, it will pay out the $100 capital when the Lend-Lease bond matures. So really they're just a single bond maturing ETF. There's 50 available. Most of them are fixed rate bonds, and there's 10 or 11 floating rate bonds, which are mostly bank bonds, and they're all over ASX top 100 corporates. All bar one is investment grade. The one that's not investment grade, which is Illumina, was investment grade, and it slipped out of investment grade, and it's on its way back in there now in the last year. Like all ASX traded securities that are ETPs or ETFs, or those fund-like products or structured products, there are market makers that provide liquidity. They're buying bonds in the wholesale market. They're putting the bonds into the listed trust and then providing XTB liquidity on the screen, basis the liquidity that they can source in the wholesale market. So in terms of the corporate capital structure, just a bit of a recap for everybody would be familiar with seeing charts such as this. This is the typical capital structure of a bank. So you see senior secured debt, covered bonds, if they exist. Not very many of those in Australia at all. But term deposits and corporate bonds are senior in the capital stack of a typical bank, or if that was a corporate, senior bonds are senior in the corporate capital structure. Any subordinated debt comes next, and then hybrids, and then equity. What that also is a chart of is from the bottom to the top, a chart of volatility. Equity is the most volatile in that stack, and obviously term deposits, $100 in the bank is not volatile. It remains at $100 for the life of the term deposit. Everything else in between is degrees of volatility. So equity, as I said, about 15% since the year 2000. Hybrids about 6 to 7%. Obviously, tier 1 hybrids are more volatile than tier 2 hybrids. The old subordinated debt are all rolling off. There's not very many of those left on the ASX anymore, simply because the regulators don't allow the banks to issue those anymore. And then senior bonds are less volatile and are next to term deposits in volatility. So you've got to take that into account in terms of when you're investing in these securities. What is the level of volatility? Because it's obviously relevant for a 7-year security on a mark-to-market basis, and also if you're going to be selling the security in the meantime. So why hold bonds directly versus in a fund? This is a key distinction for the fixed income asset class. It doesn't exist when you look at equities versus equity funds. Individual bonds mature, statement of the bleeding obvious, and bond funds and ETFs are perpetual. But in moving from the security that matures into putting that security into a perpetual vehicle, you're actually losing a very key feature, because maturity is what delivers the utter predictability that you're looking for from fixed income in the first place. So if you ask any bond fund or any bond ETF what income you're going to get, say, in October 2018, October 2019, October 2020, the answer has to be they don't know, because they don't know what's going to be in the ETF, for example. They don't know what's going to be in the index in the next 3 months, never mind a year away or 2 or 3 years away. So that predictability is lost. And of course, if you say, well, when am I getting my capital back? There is no capital back. there's only a unit price at some date in the future, and you don't know where that's going to be, and you don't know where interest rates are going to be. So that is a pretty fundamental distinction between holding bonds individually that mature versus holding them in a fund. Obviously, it doesn't exist for equities versus equity ETFs. You're not losing a fundamental feature. So you should keep that in mind. And when the US market, which is a lot more advanced, looks at this, they kind of see ETFs and bond funds as a different asset class to holding bonds individually, because they behave so differently when you actually hold them. So if you're holding bonds, for example, 5 bonds, and the RBA surprises everybody and raises rates by 1% over the next year, and in other words, rate rises come before we all expected it, you can just hold the bonds to maturity, and you're going to get exactly what you bargained for in the first place. They will still mature at $100, which is impervious to whatever interest rate rise might occur. But of course, any fund or ETF, because it's perpetual, you're going to be impacted by those rate rises or rate cuts. So the message here is not ETFs or managed funds are bad and bonds are good. It's just that they are very, very different. You get a different economic outcome, and that has to be taken into account in your decision. So how do you get access to bonds? Well, they're on ASX. You can buy them just like any share, ETF, REIT, LIC, via a broker. There is no additional paperwork. It's just like buying shares on the ASX to buy XTBs. They're obviously available on Hub24 as a platform, and you can build your own SMA on Hub24 if you chose. Some people have already done that with XTBs, have built their own SMAs on their own internal or external platforms. We are putting our #1 SMA onto Hub24 in the coming months, fixed income #1, that one's called, and we're going to put a green and environmentally aware SMA that a lot of people have demanded as well. So we will have 2 fixed income SMAs, senior bond only SMAs that will fit in between your TD money and your more volatile security SMAs or individual holdings. We've also got 4 other model portfolios which are available in a paper sense as well. So they're as easy to access as any other security on the ASX, with all the benefits of CHESS holding, etc., etc. So we're not in this lower for longer world anymore. At least nobody's talking about lower for longer. It may well stay at this level for another year or so, but probably you would all agree that most people are talking about, well, rate rises are coming at some time in the future. The ASX interbank futures contract is looking at a late 2018 25 bips rise, and maybe another one late that year or early the following year. So the first thing to think about, right, we all know bonds, fixed rate bonds will fall in price when rates rise. The first thing to think about is duration. What is my duration of my bond? If I'm holding a 30-year government bond or a 100-year Argentinian government bond they issued recently, you have got very, very high duration. So a 30-year government bond might have a duration of 20. And that means 1% rise in rates will be a 20% fall in the price of that bond when that occurs, or an expectation of that. All XTBs over the corporate bonds from the top 100 companies, they're 3.5-year average tenor. So their durations are around 3, let's say around 3. So if rate rises occur in about a year's time, then you'll be holding a security with only a duration of 2. So if rates go up by 25 basis points, that XTB will fall in value twice that amount, so it will fall in value 0.5%. So people sometimes think that they're very sensitive to rates, but a bond you buy now, rates rise in a year, you're looking at 0.5% fall in price at that point in time. But of course, if you're holding to maturity, then none of this matters. If you're buying now a portfolio of 3.5-year average and your client's going to hold to maturity, then the capital you get back is impervious to a 10% rise, never mind a 1% rise in rates. So holding to maturity, rate rises don't matter. The other thing to take into account is a lot of people ask us, should they stay in their 3-month term deposit and roll that term deposit while they're waiting for rate increases? We've done a study showing what the comparative returns are of staying in a rolling 3-month term deposit position, and obviously benefiting if rates do increase from the increased term deposit rate, versus buying into fixed rate bonds that have a higher yield at the moment. And that analysis, which you can find on our website, shows that it would take very, very significant rate increases before you're better off in the term deposits, simply because corporate bonds pay high coupons and the yields are stronger than term deposit yields. Therefore, you are in fact better off in the fixed rate bond. The other thing that we're quite excited about and we find really quite cool in a rising rate environment is turning rate rises into your friend. And the way you can do that is the way the Americans do it, and the way the British ruling class have been calling that, have been doing it for 300 years, is you take a ladder approach to your portfolio, and you have a sequence of bonds maturing at different dates. So if you had 5 years time horizon, you could buy a bond maturing in 1 year, 2 years, 3 years, 4 years, 5 years. And let's say the RBA increases rates in the meantime. Well, in 1 year, your 1 year bond is going to mature, but that $100 you're getting back is totally impervious to the rate rise, and then you're going to reinvest that into the new 5 year bond, and lo and behold, the new 5 year bond is now cheaper because rates did increase as you predicted. If you take this approach and you hold them all to maturity, and you just keep on rolling the one that's about to mature in the next year into a new 5 year bond, you actually want as many rate rises as possible, because your yields are going up overall, and the new bonds you're buying into are now cheaper because you were right, rates have increased. So the maturity ladder approach, we have one of our model portfolios as the maturity ladder, is a way of turning what seems like a downside, bonds fall when rates rise, into an upside in terms of overall portfolio performance. And it obviously works, and the fixed rate bond market doesn't disappear every time there's a rate environment. It's been around for 300 years, and so it isn't all about jumping into floating rates away from fixed. That simply doesn't happen. There are ways of using fixed rate bonds in a rising rate environment, as I've just described. The other way people look at it is say, look, I just want to take rising rates off the table altogether. I want floating rate bonds, and we do have floating rate XTBs. People tend to use those as a cash alternative in the short term and say, well, it's a bit more, 0.2% volatility is pretty low from my perspective, but it's better than my Macquarie cash management account. I'm going to go in for 6 months and then sell in 6 months, and I will have very, very low volatility in the meantime. It is not cash, but it is closer to cash than any other security you can get. Senior floating rate bonds are all issued by banks, and they are basically the most boring security in Australia when it comes to volatility. So there's the ladder portfolio, bond maturing 18, 19, 20, 21, 22. That's our particular model portfolio that we have. But you can obviously decide to pick one yourself, and they don't have to be in sequential years. You could pick whatever you like, basically saying, well, if I'm going to adopt this hold to maturity, take the interest rate impervious capital and reinvest in the new cheaper bonds, you could basically make up your own. So it's a feature of bonds, because they mature, that make it quite exciting. This is just an example. You won't be able to read the detail on this, but if you contact Simon, my colleague, or any of our other sales executives, they can provide you with model portfolio charts that show you exactly what's in the portfolio, how it performs, what the yield is, what the total return is. Or if you want a bespoke version of these, we do that on a regular basis as well. And in terms of performance, we're just showing a portfolio, one of our model portfolios, which is our high yield portfolio over the last 3 years, how it's gone versus the index. And we've used one of the index ETFs as an example. So it outperforms because you're accessing a part of the index, being the triple B rated bonds, the higher risk bonds that are in the main indices. So that particular fixed income ETF is dominated 88% by government bonds. So it's naturally going to have a lower yield because it's lower risk. Government bonds clearly lower risk than corporate bonds. So to access higher yielding corporate bonds, you can buy XTBs, and that's how a portfolio has gone versus the very widely diversified but mostly government bond denominated fixed income ETF. More interestingly, if you look at the last year, we haven't had rate rises yet, but the fear of rate rises is on the horizon. And you can see the Donald Trump election and the fear of inflation, or probably not so much fear, but desire for inflation in the US. But of course, government bonds, 10-year, 20-year, and 30-year government bonds fell in value. And so the performance over the last year of the index, therefore the index tracking ETFs, has been minus 1%. It doesn't show that in the numbers there, but that's the actual one-year performance, whereas the XTB performance was about 3.5%. And of course, when rates start rising, that index cannot do what a fixed income managed fund will do, an active manager, and suddenly go short duration and have more floating rather than fixed. The index is what the index is going to be, and if the government issues more and more long-dated bonds, as it has been doing, the index duration is going to keep on increasing month on month, and it has been increasing month on month for the last 6 or 7 years. And so you're exposed to whatever the interest rate cycle is going to do to government bonds by tracking the index. So we actually don't think tracking the index is particularly clever in a general sense, but certainly not when we're about to enter into a rate rise period of time. So the key risks of bonds, the number one risk of investing in bonds and also in XTBs. The XTBs are, the bonds are held in a listed trust. It's got a managed investment scheme. It's got an RE, and which is independent from the manager, and the bonds are always held in trust in Austraclear. Creditworthiness of the underlying corporate bond issuer is your main risk. If an issuer falls over, its bond falls over, and so does its XTB. So you're exposed to the creditworthiness of the underlying corporate bond issuer. As I said, top 100 companies, 2 failures, Babcock and Brown and Pasminco. Pretty low probability of that happening, but if it does happen, it happens. Of course, senior bonds, by being senior, there is a payout, and unlike equities, which generally get nothing in a collapse, the global historic investment grade recovery rate is 50%, so you don't lose all of your money. 50% is still pretty terrible, but it's not as bad as equities, 100%. It's felt that it's generally higher in Australia, but there isn't an awful lot of data to go on because there haven't been an awful lot of actual defaults. Liquidity risk, the bond market is not the currency market, which is very liquid. It is not as liquid as the ASX top 50 equities. The bond market is less liquid than that, and a market maker cannot conjure liquidity out of thin air. They are taking liquidity out of the bond market. We haven't seen any problem at all with selling bonds into the bond market. Australia has a supply problem, not a demand problem. So yeah, it doesn't have a sense of nobody will buy your bonds. So we have not had any liquidity problems whatsoever when people want to sell XTBs back. Sometimes there is a period where there might be a couple of days where we can't get a particular bond to buy, but when it comes to selling them, we have no problem selling them, and you won't have any problem selling XTBs. Concentration risk, if you put all your money into a Lend-Lease bond, then you've concentrated all of your exposure to Lend-Lease. But you can obviously deal with that by diversifying into a number of different XTBs. Market risk is obvious. You have market risk, but pretty low volatility on that front. As I said, the trust risk you have is in terms of the risk of the managed investment scheme not being there. So if the manager of the XTBs falls over, the law stipulates that the RE will replace the manager. If the RE falls over, the law stipulates that ASIC steps in immediately and appoints somebody like Perpetual to take over. And the whole time, the bonds, which are the security against the XTBs, are still in Austraclear, held in trust, and whether the manager or the RE falling over has no impact on that. So I think that's the end of the presentation. I'm Richard Murphy, the CEO of the firm, and Simon joining me today, but there's the list of the other advisors around the country.
Thank you very much to both of you for joining us. We look forward to seeing those portfolios, the new portfolios on HUB24. And now we're going to go over to the team in Chicago, Geneva Advisors.
Great, thank you, Anne. Really appreciate it. And thank you, Karen, as well, for helping with all this. We're really excited to talk to you all. So hello from Chicago, and good morning to you. We're Geneva Advisors. This is Jordan, and we're here to talk to you about the Australia Aware Investing, a Global Perspective. So Don and Matt are going to speak a little bit more to this in a moment. They're two of our portfolio managers here at Geneva. but I just wanted to touch base with you all a little bit on Geneva and what we do. So we are a Chicago-based. I don't think the slides. We are a Chicago-based boutique investment manager, and we have roughly a little over $8 billion in assets under management, specializing in SMAs. So, we're transparent, concentrated, and efficient. And Geneva is really, we're research-driven in terms of our investing. And that's something, Matt's going to speak to you in a little bit more about in terms of a few of the holdings that we have. And we've actually been serving, this slide might be a little behind here, I've been serving Australia for over 40 years. One of our portfolio managers, Don, has been doing so for quite some time. And, our fund here on the HUB24 platform is the Geneva Global Growth Equity Strategy. Our current team here, full team, is roughly 15 portfolio managers and analysts, but we make up the Australia Aware team, as we like to put it. So we're actually also excited to announce that we are joining forces with CIBC Atlantic Trust. If you're not familiar with them, they've been around for about 90 years, based in Atlanta, and have roughly $30 billion in assets under management. Over a dozen offices throughout the U.S., so really excited about the plethora of new resources that they're also going to be able to offer us as we work on your platform over there. So with that, I'm going to hand it off next to Don. Don's been in the business for 48 years and has been servicing clients in Australia since 1972. So really excited to hand it over to Don.
Good morning, everybody. Thanks for joining in on the webinar to listen to us talk just a little bit about our philosophy and what we do. Some of you know me, some of you don't. I hope when Matt and I are down in Australia for the month of October, we'll have an opportunity to meet a bunch of you. I started coming out when Billy McMahon was Prime Minister and Bill Snedden was Treasurer. So I've had a long history with Australia. I've made trips to all the capital cities now every 6 months since 1972. So our perspective is we're far enough away that we can see what's happening in Australia, but we're close enough that we spend a lot of time in Australia getting a sense of the Australian economy and the Australian investment climate. Right now, as we look around the world, we obviously are very concerned about what's going on at the governmental level. We have new leadership in this country. The UK has new leadership. France has new leadership. The Chinese government is up for re-election. Obviously, they're going to keep the same government. But the world's economy seems to be getting back in gear. We see continued modest growth in the United States, 2% plus going into the near future. And the mess in Europe seems to be coming under control. The situation in the Far East seems to be stabilizing. We're seeing perhaps the end of a very, very long bear market in the economy in Japan. And I think that the Chinese economy is going to continue to grow at the 6% plus area. We take a very broad look at what's going on in the world. We take a top-down approach. We want to know what's going on so that we don't miss a major economic shift. And yet we use a bottom-up approach also to talk about individual and invest in individual stocks. As I mentioned, Matt and I will be in Australia the month of October going around the capital cities, and we'll look forward to meeting with any of you that have an interest. I'd like to give the phone over to Matt now to talk about the portfolio we have on the HUB24 platform. Matt, here you go.
Great. Thanks a lot, Don. So looking at slide 6, we can take a look at some of the portfolio characteristics. Our approach to equity investing is really focused on deep fundamental research, as Don had mentioned. We have a team here in Chicago of global research analysts with sector coverage and a global mandate. We target sort of 20 to 25 holdings. Right now we're at 25 holdings, which you can see here. We're looking for high quality companies, but ones that still have an attractive dividend yield because we think that's a real sign of health for companies. You can see here as Don mentioned, we are very much Australia aware, and what that means to us is that we're almost always going to be underweight banks and resources because we understand that's a big part of the ASX, and we're going to be overweight many of the more growth sectors, technology, healthcare, consumer discretionary. These are the areas of our specialty, the areas that we specialize in. Our firm has specialized in these types of stocks and these sectors for over 14 years now, and that's where our analysts are really trained and spend most of their time. The other thing that I think is a little bit unique about the portfolio is that even though we're only 20 to 25 stocks, we try to develop portfolios that are really still well diversified, and what that means to us is a core satellite approach. Roughly a third of the portfolio is what we are going to call more index names that we still research really well, names that we're still very comfortable with, but names that are going to be household names like Nestle, Apple, those sorts of companies. Where we really sort of add a lot of value is in the other 2/3 of the portfolio, which are more unique, well-researched companies that you probably haven't heard of as much. And I wanted to spend a little bit of time today going through 3 of our favorite names right now that fall into that unique bucket. The first one's A.O. Smith, which is a U.S. company that manufactures commercial water heaters, boilers, and treatment products. The reason why we really like A.O. Smith is because there's 2 parts to this business. The core part of the business is U.S. based, and it's mostly water heaters for residential and commercial buildings. What we really like about it, though, is that it's not really a new construction play. The boiler water heater market is really a replacement market. It's highly predictable, it's highly cash generative, and right now it's a unique time because what we're seeing is more and more people moving to energy efficient products, which is driving increased sales. This part of the business is also generating enough cash that it's allowing A.O. Smith to move into China and India, where the really exciting growth is coming. In China, A.O. Smith was early to go there. They've been in China for a number of years, and what's really unique about what they've done is they've developed over 9,000 points of distribution in China, both retail stores, partnering with other retail stores, and being really early to start selling online through the likes of Alibaba and Tmall and those sorts of online players. In China, it's kind of interesting. The water heater is often very visible. It often sits right in your living room, and it's really become a branded consumer product. And what you can see here is that A.O. Smith dominates at the high end. They've really established themselves as the leading and premier maker of water heaters. And what that's allowed them to do is transition in the last 2 years to selling more water filtration and air filtration. We've all seen the pictures of whether it's Beijing or Shanghai and some of the really massive pollution issues they have there. And the air filtration business has been really a great ad for A.O. Smith. What's interesting about the businesses is that the air filtration systems, they look like little robots actually, and they're about $1,000 US, so they're not cheap. But what happens is that they have an actual gauge on them that measures the air quality within your home. And for a very distrusting Chinese consumer, it's really important for them to have that sort of affirmation that the product is working. And A.O. Smith's great brand name has allowed them to have a lot of success in that area. A.O. Smith is now going to India, and we think they're going to replicate the success in China and India and have many years of growth. So that's one name we really like. Another one's Orpea. Orpea is a French company that is the leader in retirement homes and healthcare facilities throughout France and really most of Western Europe. They have 775 facilities, the majority, as you can see here, in France, but they've done an excellent job of expanding into Germany, Switzerland, Belgium, and Spain. They are now moving to the east, and where they've started to acquire units throughout Eastern Europe. What we love about the business is a couple things. I mean, there's the obvious trend of an aging population in Europe, but what Orpea has been really smart about is going after the high end. So the Orpea retirement homes are really almost luxuries on the luxury end. They are offering a higher quality facility, better food, and better health care. This has allowed them to really take a lot of market share. And also what we like about it is that only about 20 to 40% of revenues come from government payments. So this is really a consumer product. It's really that upscale customer that wants just a better living experience. This industry is highly fragmented, so what Orpea has been able to do is buy up a lot of small operators, upgrade the facilities, and when they do this, they buy the real estate. This has allowed them to build a real estate portfolio of over 3.6 billion euros in real estate, which is another aspect that we really like. rarely would we want to own just a straight real estate company, but a real estate company with such a strong operating company is a really, really attractive to us. The final thing that we love about Orpea is that recently they've decided to go to China. So this year they've opened their first facility in China. China is also on the verge of having an age issue, and their population is starting to age rapidly. What they've done in China, though, is what they've done in Europe, which is go after the high end. So the opening price points in China are roughly 10 times the cost of an average house. So we think this is the right way to go after the high end and really go for that niche market. The final company that we'd like to sort of talk about that's currently in the portfolio is Yum China. Yum China is a spin out from Yum Brands here in the U.S. Yum China operates over 7,500 KFCs and Pizza Huts throughout China. In addition, they're opening over 400 units per year and remodeling 800 units per year. What we love about Yum China is that clearly the middle class has emerged in China, and they really have an appetite to eat more food away from home. Yum China was early to go to China, so they're very well established. But what we really like about this management team, and management team is really important for us. We're very much about meeting and understanding our management teams. And what we love about this team is they've really moved with the times. They've been very proactive in developing online ordering. They're one of the largest delivery companies in China, and they have over 100 million participants in their loyalty program. It's just absolutely amazing to think about 100 million people are on the platform for purchasing and buying food through Yum China's delivery system. The company continues to grow, and we think it has a massive top-line opportunity, but really the almost more exciting part is on the margin front. When Yum China was part of the bigger Yum Brands, it was really undermanaged. Pizza Hut has over 100 items on their menu, so it's a little bit different than the Pizza Hut that we may be used to. They had everything from pizza to actually escargot, which is quite amazing. The new management team is really cleaning that up, getting focused on the core, and we think that there's going to be over 15% earnings growth for many years from a combination of top-line growth and improved margins. This company has no debt, and it's really one of our favorite names. We've mentioned, as we've mentioned here, all three of these names we've talked about have a bit of a China exposure, and while China is only 10% or less than actually 10% of the portfolio, a lot of the names that we look at do have some sort of growth coming from China. And that's a function of both the bullish stance we have, which Don mentioned earlier, but also just, we do think that the consumer will continue to grow. In China, we've seen retail sales have been growing over 10%, and what we think that it will continue to happen is that strong GDP growth will be more driven on the consumer retail side than on the manufacturing side. So those are three companies that we really like and we really wanted to focus on. And as Don mentioned, we'll be in Australia most of October, so we hope we can meet with some of you.
Thank you so much. I'm glad we finally got you back on the line there. Now we're going to open up for questions at the moment. We've had a couple of questions come through from the advisors on the line, and this one is for XTB, and the question is from Chris Faddy. Are you able to show the way the price of the XTB tracks the underlying bond?
Yeah, sure. The first thing to say there, and I should have said this during the presentation because I didn't mention what the fees were. The fees for XTBs are in the price of the XTB. So that's one thing that's the difference between the underlying bond and the XTB price. So the fees for the fixed rate bonds are 40 basis points, and for the floating rate bonds are 20 basis points. The impact of that fee, what it does is if there is a 4.4% bond, it would become a 4% XTB, or for its floating rate, if there was a 2.8% floating rate bond, it would become a 2.6% XTB. So the fee is one difference between the underlying bond price and the XTB price. But then after that, the question is still relevant as to how does it track it? Is the market maker taking out much of a margin themselves? Every day we release on the ASX a closing price from the day before of the underlying bond, so not the XTB. So for the 50 XTBs, you can go onto the ASX and see what was the closing price, and the closing price is actually a midpoint of the best bid and offer at the closing time on Bloomberg. So that gives you a barometer of, well, there was the bond price, what did I see XTB prices at? And some people actually track that on a day-to-day basis to see that the underlying bond market prices are not very different to the XTB prices. So the fee is one element, and then the other element is how does it actually track. So we're actually doing some work on that. It's a very pertinent question, because literally this week we're getting into ASIC and the ASX a study on that we've been conducting to show how they have correlated, and the answer is it's been very, very close correlation. Really the only difference is the fee, and between 0 and 5 basis points of other spread that the market makers have charged. So the reason ASIC is looking at that is we're keen to start moving into the primary market and start issuing XTBs over primary issues of bonds, so that we could have an XTB IPO alongside a Telstra corporate bond IPO. So that's exciting from our point of view, but that's why that question is very relevant.
Thanks, Richard. And another question for Geneva here, which is, what has the long-term performance of the Geneva global growth strategy been?
Matt, you want to talk about that?
Sure. So so we've been on the Hub24 platform for less than a year, so it's still, on the Hub24 platform, we're still getting going, but this product has been managed by Don for over 15 years, in which we have had outperformance since inception, as well as on a 3 and I believe on a 5-year basis as well. So when we're in Australia, and if anyone's interested, we'd love to meet, and we can sort of walk through what the performances look like over the past. And on Hub24, the portfolio that we've designed is slightly more concentrated than what we have historically done. That was the way we kind of designed it, but the returns have been tracking to a similar sort of outperformance.
Okay, great. And just another question here for XTB. Is there a cost if we follow your model and implement it ourselves?
No, there's not. You can call us and say, can I please have the model? And we will give that to you on whatever frequency suits you. Some people do that on a daily basis. Some people do it in a weekly, etc. So we're happy to do that.
Excellent. Thank you. And one more question here for Geneva. With all the fear in the market, aren't we better just staying in Aussie shares?
That's a great question. The answer is diversification lowers risk. It doesn't increase it. With the world the way it is today, the Aussie market, the Aussie economy, is a natural resource-based economy. So if you're worried that energy prices may not go back up, if you're worried about coal prices, which you should be, if you're worried about any minerals or any agricultural products, the best way to protect yourself is through global diversification. And what we take great pride in is the amount of research we do, the amount of time we spend visiting companies, not once or twice, but on a regular basis, so we can understand what their business plan is and question it, and help our clients to have the diversification that is going to give them positive returns long term.
I would also add to that, I think, some of the acceleration you're seeing in Europe in GDP, as well as Japan. I mean, it actually was surprising how strong GDP was in Japan. You look at what's happening with the macroeconomic acceleration, and then contrast that with valuations that are still trading, near long-term averages, while the U.S. and some of these other areas, have really are trading at much higher levels. So I think, while the Australian market, while there's often going to be people that are going to go for a home market bias, I think that the acceleration in GDP growth is really going to start to allow multiples to expand, especially in Europe and parts of Asia. So I think that's one of the things that we're very much excited about.
Great. Thank you. So I think we've come to the end of our questions. So I'd like to thank both XTB and Geneva for presenting here today. Now, if anybody wants to get in touch with either XTB or Geneva, please let us know, and we're happy to facilitate that conversation. And keep an eye out for our next HUBsights webinar topic, which we'll be releasing soon. Thank you all for joining us today.